Hello friends, welcome to our class wherein we'll be discussing about the accounting concepts. Accounting concepts are nothing but the ideas or the rules, the things to be followed by an accountant while preparing and presenting the financial statements. So these are basically the rules or the ideas which we need to have in our mind whenever we are working as an accountant, whenever we are doing the job of an accountant. Or in other words, we can say all the accountants across all the industries, all the different types of businesses have to follow these accounting standards or accounting concepts or accounting principles or accounting postulates, whatever you say. These are basically the rules which are generally accepted across the industries. And what happens, what is the benefit of following these accounting concepts? This would give you a fair idea. Transparency would be there, comparability would be there, objectivity would be there. So the financial statements would be free from the accounting, from the biases, personal biases, right? So these are very important. These are so important that without these, an accountant cannot survive in the accounting world, right? So let's start our class related to the accounting concepts. The first concept is the property rights concept. This concept says that every organization has a right over the property it possesses. Now, right means what? It has a right to use this asset, it has a right to transfer that asset or the property. Say, for example, there is an example given of the machinery. If I talk about a machinery, the organization has a right to use the machinery for its productional activities in the manner which it deems fit. It has a right, since it is the property of the organization, it has a right to use that machinery or discard that machinery, right? So it says this can be transferred from one entity to another. Without having the right, you cannot transfer a property or any asset or any item out of your organization. So this is the simplest of all the accounting principles, which says that the property rights principle needs to be followed, which means every organization has a right over the property of it, right? The organizational property can be used in the manner which in any manner which the organization wants to. This is all about the property rights concept or the property rights principle. Then we talk about the business entity concept. What is business entity concept? We have already discussed this earlier also. Let's discuss this once again. Let's see, say for example, there is a person, Mr. A. He is a consultant. So he is into the consultancy business, say for example, which means he has some receipts from consultancy and he has some expenses related to those consultancy services. He is also working as an employee, say for example, at some other place. He is also an employee wherein he gets some salary and also he needs to expense out something. Now what happens if he has a bank account wherein his personal things as well as professional things as well as things from salary are all kept in the same place? If all the money received from all these sources are kept in the same bank account, similarly all the expenses, be it related to his profession or his employment or his personal expenses, if everything is done with the same bank account, what would happen is he may not be in a position to find out as to what his income is as a consultant or how much is he saving from his employment. So what the accountant say, what the accounting principle says, that the accountant needs to keep this thing in mind, his mind, that these are all different entities. Mr. A is a different entity. His consultancy business is a different entity. His employment or any other work is a different entity. So he needs to treat each entity as a separate one. The business is different, is not equals to its owner, or we would treat these as two separate owners. One would be the business, second would be the owner. So the transactions would be done for the business separately and for the owner separately. And the accountant for an organization is supposed to work for the business only. Right. So the business entity concept says that the accountant needs to keep this thing in his mind, that the business is separate from its owners. Because of which what he does is he maintains separate set of books, separate for the business and separate for the owner as a capital employed in that business. We'll talk about this in our future classes, right? So the simplest meaning of business entity concept is that the accountant needs to keep this thing in his mind, that the entity is separate and distinct from the owners. So the entity is liable towards the owner. What does this mean? Suppose Mr. A is investing some money in the business. This is entity number 1, this is entity number 2. Mr. A invested the money in his business. Now it is the responsibility of the business to repay back money to Mr. A. This is called as the business entity or separate entity concept. Clear? So we would say that in a limited liability company, in an LLP, the enterprise is liable to the owners or the shareholders to the extent of the proportion of capital invested. We have seen in different forms of organization wherein we have said that in case of an individual or a sole proprietor, the liability of the business is the liability of the owner. Similarly, in case of partnership, we have said that the total liability of the partnership is the liability of the partners individually. That is called as an unlimited liability. Now, if we talk about the limited liability company, we would say that the liability of the organization is limited to the extent of the amount invested by the owner. Right? So all these concepts are of use only when we talk about separate entity or business entity concept. Hope this is clear to you, right? Then let's talk about the going concern concept. What does this concept says? It says the accountant needs to keep this thing in his mind whenever he is doing the accounting function, that the business would continue for a foreseeable future. It would continue for an infinite period. Why is this required? Say for example, what happens if I think that the business would be coming to an end within next 6 months? Then my accounting or my financial statements may not represent the actual picture. Why? Because the machine which I have purchased having a life of 10 years, how would I show that machinery in my books of accounts if I am not thinking, if I am not of the opinion that my business would continue for a foreseeable future or for an infinite period, right? So we need to assume, or the accountants need to assume, that the entity for which he is accounting would have an infinite duration, right? If there is anything to the contrary, say for example, if there is any slightest of hint that the company may go bankrupt within next 6 months, looking at the finances, if the accountant feels that the company may go bankrupt within next 6 months, what he has to do? He has to make a separate disclosure for the same. Right? This need not be mentioned anywhere, but if something contrary to the going concern concept comes to the knowledge of the accountant, he has to make a separate disclosure saying that looking at the financial position or the finances or the working of the organization, there is a possibility that the going concern concept may not be applicable in case of this company because of these reasons. So you need to make a clear disclosure so that the users of accounting information the users of accounting information will be making their decisions based upon this fact that this company is not going to be there for a longer period. Similarly, the providers of finance, if you do not follow this principle, this concept, what happens? Whoever the finance provider are, say for example banks or the money lenders, what happens if the bank thinks that the company would be going to be closed down in the next 2-3 months? In this case, the banks would not be lending money. Similarly, the lenders of money do lend the money to the organization only because they have this thing in their mind that the business would be continuing for a longer period. At least it would be covering this financial year, which is of 12 months. So the going concern concept says we need to have one thing clear in our mind whenever we are doing the accounting work, that this company would be continuing for years to come. So based upon that, you have things like assets, you have things like liabilities. We'll see what these are. Assets and liabilities are those things who have a life of more than 1 year. Similarly, the amounts payable, accounts receivable, these are created only because we think that we'll be seeing the next financial year also. If we do not follow the going concern concept, or if we think that our company is going to come to an end within this financial year, there won't be any payables in the books of accounts. Similarly, there won't be any receivables in the books of accounts. Similarly, there won't be any assets or liabilities in the books of accounts. So this is again a very important concept which says the accountant has to assume that the business would be continuing for an infinite period. So based upon that, this accounting would be changing. Right? The basis of valuation of all the resources is influenced by their future value. It is influenced by their future value. Here it is. Yeah. We are concerned about the future, not the current market valuation. We have seen that we talk about when we value it, we value on the basis of historical cost, not on the replacement cost or the current cost. Right? So whenever we buy any asset, we assume that this asset would be giving a benefit to the organization for more than 1 year, for infinite period. Every asset has a life of its own. It can be 10 years, 15 years, 20 years. So, and we also assume that this organization would be at least seeing those 10, 15 years. So based upon that, we do the accounting, right? Then let's talk about the money measurement concept. Money measurement concept says all the business transactions means buying and selling, receiving and paying. All the business transactions needs to be measured in terms of money. Because money is the common denominator based upon which we can take some meaningful information out of it, or based upon which the decisions would be made by the users of accounting information. We need to have some common denominator. Therefore, all the transactions, all the economical transactions, I would say all the economical transactions are mandatorily required to be measured in terms of money, and the recording or reporting would be done in terms of money itself. Now which money is that? This accounting concept also says that you need to follow the currency of the country in which you are registered. Say for example, if I am a company registered in India, my books of account should be prepared in INR, Indian rupees. Similarly, if any company is having its head office in the US, multinational companies we are talking of, if any company is registered or is having its registered head office in US, then its financial number should be in dollars. Say for example, if I have a company having branches in India as well as in US, then what I'm supposed to do? I need to see where is my registered office. If it is in India, then I need to make my financial statements in Indian rupees only. If I am also if I am also listed in the US stock exchange, then their disclosure norms will be there that the financial statements would be converted into US dollars. But otherwise, if nothing is mentioned, the Indian company has to prepare its financial statements in Indian rupees whenever disclosure is to be made to the Indian legal authorities, right? It says money is to be represented as a common denominator for all the purposes, addition, subtraction, or recording of that and disclosure of that. The advantages of expressing the transactions in monetary terms. It provides a simple measuring device, right? You have different types. So say for example, if I buy 10 fans in my books of accounts, I will not record that I have purchased 10 fans. I would say fans purchased for 20,000 rupees, right? I don't record the quantity or the number of fans that I have purchased. What I do is I write or I record the amount which has been expensed out to purchase those fans. When the things are expressed in monetary terms, they are summarized by using this monetary relationship, right? Then comes the matching concept. What matching concept is all about? It says if we talk about 2023, I have some income for the year 2023. I have some expenses for the year 2023. There is also a possibility that I have received some money related to the year 2022. Like some consultancy fee was payable by my client related to the previous years. He did not pay me in the year 2023. Sorry, he did not pay me in the year 2022. Now he is paying me. So that is also the income which I have received in this year. Similarly, there may be some expenses which are related to the year 2024, next year. I paid some advance consultancy fee to some consultant. I said that you take this money, you may provide this facility or you may provide the consultancy in the year 2024. Now this expense is not related to this period. So I may not be in a position to calculate the actual profit or loss for the year 2023. So in order to calculate the actual profit or loss or the financial position for the year 2023, what I need to do is I need to match the income of 23 with the expense of 23. Whenever I match the income of 23 with the expense of 23, what I get is the profit for the year 23. I may receive the money related to previous year. I may receive the money related to next year. But for this year, what I have to do is I need to match the income for this year with the expense for this year only. If I am preparing the financial year for the financial statements for the year 2022, what I would do is I would match the expenses 22 with the income of 22. Sorry, this is 24. 22 would be here. I hope this is clear. The matching concept says the accountant needs to keep this thing in his mind that all the expenses for a particular year should be matched with the expenses of that particular year only. In other words, the income or expenses related to the previous year or next year needs to omitted from the financial statements. There would be a separate treatment for them. We would be showing it as an advance payment, advance expense, or accrued income, income received in advance. There are different treatments, but they are not used to calculate the profit or loss for this period. Hope this clarifies the accounting concept of the matching concept, right? The next concept is about consistency. What is consistency? Repeatedness, doing the same thing year after year. See what happens in accounting, you have different principles. When we were discussing about this, we said that different companies follow different principles. Say for example, if I take a case of depreciation. What is depreciation? We have a full-fledged topic on that. What is depreciation? Depreciation is the reduction in the value of an asset due to its use, or due to passage of time, or due to obsolescence. Every asset has its own life. Say for example, if I buy a building today worth 10 lakhs, the value of this building would go down after 5 years. Why? Because the useful life of this building has come down from 10 years to 5 years. I'm talking about the building. You should not get it confused with the land. You may say that I have purchased a flat 5 years back. Now this flat is worth more than what I have purchased it. That is not the case here. That is the rate which is dependent on the demand and supply there. What we are talking about is, we are talking about the life of that building. Even if we talk about that flat, the life of that flat has gone down by 5 years now. So the usefulness of that flat has gone down. So any reduction in the value of an asset due to its usefulness is called as depreciation. So we were talking about the different principles which are followed by the different organizations, different companies or different entities. They have straight line method of depreciation. They have written down value of depreciation. They have sum of years digit method also in depreciation. Which means whenever you talk about depreciation, it can be done by different ways, by different organizations. Well, when it comes to income tax, it says that you need to follow this method of depreciation only. We are talking this in general. In general, different types of organizations do follow different types of depreciation methods. Some follow the straight line method. Some follow the written down value method. Now this concept says whatever method you are following, please do follow that. But the same method should be followed year after year after year. That is called as the consistency. It is, you cannot do that in the first year you are following straight line method, and then in the next year you do the written down value method, and then in the third year you talk about the straight line method. Why? Because depreciation is an expense. When it comes to accounting world, depreciation is an expense, and when you keep on changing the methods of expenses, your profit may not be showing the actual picture. There is a possibility that you are trying to play with your profits. So this rule says, or this concept says, consistency means whatever treatment you have done in a particular year to a particular transactions needs to be treated in the same manner. Now what if I don't treat it the same manner? Again the same thing. You need to make a disclosure. You need to say that we were depreciating this particular asset on the basis of straight line method till the previous year. From this year, due to some legal requirements, we plan to change this method to the other method called as written down value method. Earlier I was doing straight line. Now I plan to do this written down due to some compulsion, some legal compulsion. If I do that, I need to clearly mention that the consistency has not been followed in this year in relation to the depreciation, because of which this is the impact. The impact of that needs to be mentioned. Is this clear? The consistency concept. I repeat, it says the accountant needs to keep this thing in his mind that whatever rules he has followed in treatment of any transaction the previous year needs to be followed consistently year after year. Again, the same thing, this would have more transparency in the financial statements. Proper disclosure would be there, proper comparison would be there. If I do the comparison of a company with the same company over a period of time, say 2021, 22, 23, if all the rules have been followed, I would say that the profit has increased, or I would say the profit has decreased, or the profits are stable. Suppose if my rules have been changed, my profit would keep on changing. Then I may not be in a position to compare myself or my organization. Similarly, comparing with my competitors, if they are following some different rule and if I am following some different rule, then our profit may not be comparable. In that case, what we need to do is we need to reconcile, saying that okay, he has followed this method of depreciation, he has followed this method of depreciation. Now what if both follows the same method of depreciation? Then we would be in a position, then we would be on a common platform as to find out what the actual position is. So in simple sense, consistency is nothing but repeating the accounting treatments or accounting rules year after year. We did not change this every year, right? So it says once the choice is made, you have a choice of following straight line method or written down value method of some of these. You have a choice. Once you have made that choice, you need to follow this same on a consistent basis, right? Then we have a realization concept. What is realization concept? Realization means to when to realize or when to think that we have made this money. Let us take an example. Say for example, if I sell something, suppose if I am a seller of laptop, I have given this to the person or to the buyer. The question is, when should I recognize this to be my sale? Say for example, if I tell him that if you don't like this within a week, you can return it back to me. Then the simple general knowledge says that you cannot treat this as a sale till 1 week expires. Because within this week, this buyer has a right to return these assets back to you. What if he hasn't paid you in cash? If he has not paid, can you treat this as an income or can you treat this as your sale or turnover? The answer would be yes. So this says whenever the right towards the use of that property are transferred, whenever the right to use a particular property is transferred, that would be treated as a sale in the books of accounts. Right? Exceptions would be these conditions, return back basis. But in general, what we say? We say we would treat the transaction as an income or expense when the right to the ownership is transferred. Right? When we do this, there won't be any biasness. Personal bias won't be there. There is no chance, there is no possibility that one would be treating this transaction as an income, the other won't be treating it as his expense. That is not permissible in the accounting world. Why? Because of this realization concept. What this realization concept says, it determines the point of time. Decides the point of time when the revenue or profits can be recognized objectively. When can I treat a transaction to be a sale for me? The moment when the ownership or the rights to use that asset is transferred, I would say that the asset has been transferred. So realization concept says when to recognize or when to find out or when to record a transaction, what is the point of time for recording revenue for you is the realization concept, right? Then we have conservatism concept. What is conservatism concept? It says the accountant needs to play safe. He needs to be conservative. Means being safe. playing on the safer side. What does this mean? If he anticipates any losses which may happen in future, he would record it. If he anticipates any gains related to future, he should not record that till it is not realized, right? Which says, the conservative concept says you need to provide for all the foreseeable losses, but you should not record the gains till they are not received in the organization, right? So we need to have, as an accountant, we need to have a conservatism approach, which says you provide for all the foreseeable losses, but you should not account for the gains which may happen, which you are anticipating to happen to the organization in the coming future. We would record that as a gain only when the gains are realized, right? So this is the rule to be followed. Anticipate no gains, but provide for all possible losses. And if you are in doubt, write it off. What does this mean? Say, for example, you have sold something on credit to Mr. B. So he becomes insolvent. The moment you come to know that he becomes insolvent, what you do is you write that off. You say, it is my bad debt now. Right? The moment you come to know that there is a possibility of incurring losses in future, you need to record it then and there itself. But if you are anticipating some gains, you should not record it until they are realized or received in the organization. What does this concept has? It has a demerit of understatement of profits and values. How the profits are understated means the expenses are shown and the income is not shown. Expenses are shown but the income is not, which means you are increasing the expenses. In other words, you are reducing your profits, or the profits or the values are understated, right? So there is a demerit of that, but still it has a close nexus with the idea of capital maintenance. What is capital maintenance? We have discussed this in our earlier classes. That capital maintenance is nothing but the capital in the beginning is equals to the capital at the end. Then you say that the capital has been maintained. If the capital at the end is greater than the capital in the beginning, you say the capital has increased. In other words, you would say the reverse of that, you would say the capital has eroded. Erosion of capital has happened. So if you follow this concept, you would be following the idea of capital maintenance in your books of accounts. So I hope these accounting concepts are clear to you. These are nothing but the ideas, the thoughts, the assumptions, or the rules which needs to be followed by an accountant whenever he is entering the transactions or whenever he is reporting the results to the users of accounting information. These have evolved over a period of time and these are accepted across all the types of organizations, across all the countries. So you'll find majority of these concepts being followed in almost all the countries. Why? Because these are the generally accepted accounting rules. Clear? Thank you so much. We'll be talking about the other accounting concepts in our coming classes. Thank you so much.